A 22-year-old in Ohio and a 32-year-old in California both start investing $500 a month. Same salary, same strategy, same discipline from the day they begin. Both retire at 65. The 22-year-old ends with about $1.6 million. The 32-year-old ends with about $725,000. The 22-year-old contributed $60,000 more over their lifetime. They end up with $870,000 more in the bank. That single 10-year gap, starting at 22 instead of 32, is worth almost $1 million. And most people don't know it's happening while it's happening. This is the thing nobody tells you about your 20s. The financial mistakes you make in this decade are not all equal. Some of them will cost you a vacation. Some of them will cost you a house. And some of them will cost you 7 figures of lifetime wealth without ever showing up on a monthly statement. In the next 11 minutes, I'm going to rank the biggest financial mistakes of your 20s on a tier list, from D tier up to S tier. The rankings are based on hard math. Specifically, the lifetime dollar cost of each mistake, calculated at a 7% real return over a 40-year compounding window. By the end, you'll know which mistakes to panic about, which ones to fix next, and which ones the internet dramatically overhypes. One rule before we start. This script doesn't moralize. Financial mistakes are not character flaws. They're math problems. Some are bigger math problems than others. Here's the scale. S tier costs you over $500,000 in lifetime net worth, or locks you out of compounding for a decade or more. These are structural. They change the whole trajectory. A tier costs you between $150,000 and $500,000. Recoverable but expensive. B tier costs you between $40,000 and $150,000. Painful but fixable. C tier costs you between $10,000 and $40,000. Noticeable inefficiency. Not life-defining. D tier costs you less than $10,000. The ones the internet loves to yell about and you should mostly ignore. Now let's rank them. S tier. The catastrophic mistakes. There are 3 of them. Mistake 1. Not investing in your 20s at all. This is the compounding vacuum. Go back to the opening example. A 10-year delay from age 22 to age 32 costs about $870,000 in ending retirement wealth. Not because you saved less money. You literally saved the same amount. Because the money you did save had 10 fewer years to compound. The behavioral mechanism is hyperbolic discounting. Your brain dramatically overweights pleasure right now compared to pleasure 40 years from now. Future you at 65 feels like a stranger. Present you at 25 wants the concert ticket. So investing keeps getting pushed to next month. The reframe. Your 20s don't build wealth. They decide whether wealth is possible. The capital you deploy in your 20s does most of the heavy lifting. The capital you deploy in your 40s is just running to catch up. Mistake 2. Ignoring the 401k match. This one is worse than people think. Let's do the math. A 24-year-old earning the median salary of $41,000 at a company with a very standard 50% match on the first 6% of salary. If that employee never contributes, they leave about $1,235 a year on the table from the employer alone. Compounded at 7% for 41 years, the lost employer match alone is roughly $275,000. But that's not the full picture. Because if you're not contributing the 6% to trigger the match, you're also not contributing your own 6%. Add those together, and the total compounded loss is closer to $825,000. This is S tier. The behavioral mechanism is status quo bias. If the company doesn't auto-enroll you, the default is non-participation. The friction of clicking through the benefits portal and picking funds beats the motivation to do it, so most people don't. The reframe is brutal. Refusing the match is not neutral. It is a voluntary 3% pay cut, taken every year, forever. Mistake 3. Marrying someone you are financially incompatible with. This one belongs in S tier. and most personal finance content refuses to talk about it because it feels uncomfortable. The data doesn't care about comfort. A 2021 Ohio State study found that divorced respondents experience an average wealth drop of 77%. A Rand Corporation analysis found that couples who divorce after 50 lose roughly 40% of household assets. The average divorce runs about $15,000 just in legal fees. The real cost, the one that wrecks lifetime wealth, is the years of financial dysfunction before the divorce, plus the assets split after. This is not about finding a partner with the same income. It is about finding a partner whose actual relationship with money, spending, debt, saving, is compatible with yours. Financial incompatibility in a long-term partnership compounds the same way investments do, just in the opposite direction. The reframe. Marriage is not just a romantic partnership. It is a financial merger. Do your due diligence before the merger. Those are your 3 S-tier mistakes. Miss the compounding window. Miss the match. Miss on a financially incompatible partner. Any one of these can cost you most of a retirement. Now, A-tier. Severe but recoverable. Mistake 4. The car trap. In the first quarter of 2026, the average new car payment hit a record $773 a month. The average loan term stretched to 70 months. The average amount financed was $43,899. And 20% of new car buyers signed up for monthly payments of $1,000 or more. Do the math. If you finance a new car continuously from age 25 to 65 at an average $773 a month, you spend $371,000 in cash on car payments over your working life. If instead you bought reliable used cars for $350 a month and invested the $423 monthly difference at 7%, that compounds to about $1.1 million by age 65. Solidly A-tier. The mechanism is hedonic adaptation plus mental accounting. You get used to the new car smell in 6 weeks. Then you need a newer car to feel it again. And you stop seeing the car payment as a variable you can eliminate. It becomes a fixed cost of being alive, like rent. The reframe. A car is transportation, not a wealth-building asset. The normal American car payment is quietly the single largest destroyer of middle-class wealth. It just doesn't look like one, because everyone you know has one too. Mistake 5. Taking on significant debt for a low-return degree. Student loans are not universally bad or universally good. The answer depends almost entirely on the specific degree. According to the Education Data Initiative, a business finance degree has a projected lifetime ROI of 1,842%. Computer engineering sits at about 1,744%. Economics at 1,708%. Those are legitimate financial investments. Now the other end. Education, as a degree, has a negative 55% lifetime ROI. Liberal arts and humanities, negative 43%. Family and consumer science, negative 39%. This doesn't mean those degrees are worthless. It means they are expensive consumption, not investment. If you take on $60,000 in debt for a field with a median starting salary of $45,000, you're signing up for 15 to 20 years of loan payments that crush your ability to invest anything else. The average borrower now takes about 20 years to pay off student debt. A-tier. The driver is the sunk cost fallacy. The reframe. Not all education is an investment. Some of it is incredibly expensive consumption. Be honest with yourself about which one you're buying. B-tier. Significant but fixable. Mistake 6. The lifestyle escalator. A 28-year-old gets a $15,000 raise. If they absorb 80% of it into their lifestyle, bigger apartment, nicer gym, more dinners out, they're spending about $1,000 extra a month and saving $250. If instead, they saved that $1,000 a month and invested it at 7% from age 28 to 65, that one raise produces over $2 million in retirement wealth. The problem is that your brain adapts to the new apartment in about 3 months. The joy fades, but the expense doesn't. Hedonic adaptation is ruthless. Empower's research found that 74% of people believe more money would solve most of their problems. And that belief is what makes every raise feel insufficient within months of receiving it. The reframe, a raise is a test. If your expenses rise exactly in step with your income, you are running faster just to stay in the same place. Mistake 7. Carrying rotating credit card debt. In the first quarter of 2026, the average credit card APR on accounts assessing interest was 21.52%. The average balance among cardholders carrying debt was $7,886. Total U.S. credit card debt hit $1.277 trillion at the end of 2025. Carrying an $8,000 balance at 21.52% while making only minimum payments costs tens of thousands of dollars in interest alone over a decade, before you ever get to compounding opportunity cost. The money isn't invested. It's actively destroyed. The mechanism is mental accounting. Your brain treats the pleasure of the purchase as one event, and the pain of the bill as a completely separate event. The interest rate gets discounted to near zero in the moment of swiping. The reframe, credit card debt isn't a debt problem. It's an emergency. A guaranteed negative 21% return on your money, destroying wealth faster than any legal investment can build it. Mistake 8. Forcing a home purchase in a high-cost metro when renting is cheaper. The conventional wisdom says, buy as soon as you can. That wisdom is now math-broken in many U.S. cities. In 2026, the national median monthly mortgage payment is about 20% higher than median rent. In San Francisco, Los Angeles, Seattle, and New York, the premium is much higher. If you force a purchase where renting is $1,000 a month cheaper, and you fail to invest that difference, the opportunity cost plus transaction costs of 6 to 10% to sell, plus 1 to 2% annual maintenance, easily exceeds $100,000 of lost wealth over a decade compared to renting and aggressively investing. The reframe. Rent is the maximum you will pay for housing each month. A mortgage is the minimum. Renting and investing the difference beats homeownership mathematically in most modern high-cost metros. Mistake 9. Not having an emergency fund. The Federal Reserve's 2024 Economic Well-Being Survey found that only 36% of adults aged 18 to 29 had 3 months of expenses saved. Overall financial resiliency has dropped from a 2021 high of 59% down to 54% of adults saying they could cover 3 months. The cost of not having this buffer is not the missing $15,000. The cost is that when a real emergency hits, a car repair, a medical bill, a job loss, you go straight to credit cards at 21% interest. That single event can take a decade to dig out of. It wipes out $50,000 or more in compounding you would have otherwise earned. The reframe. An emergency fund is not an investment. It is insurance for your investments. It prevents you from selling compounding assets or taking on toxic debt when life inevitably breaks. C tier. Moderate, still worth fixing. Mistake 10. The status purchase. A 25-year-old spends $15,000 on a luxury watch, a designer handbag, or an engagement ring that exceeds their budget. Even if they don't finance it, the opportunity cost of that $15,000 at 7% over 40 years is about $224,000 of future wealth. If they financed it at high rates, the damage compounds further. The reframe. Wealth is what you do not see. The luxury items people buy to show they have money are often the exact reason they do not have wealth. Mistake 11. Speculation as a substitute for investing. Sports betting and meme coin trading. A 2026 report found that 34% of Gen Z actively engages in some form of betting activity, and 80% of young people using high-risk speculative assets say they're doing it because they feel financially behind. They're trying to catch up faster. The math is simple. If a 25-year-old loses $100 a month to sports betting or speculative crypto instead of investing it in an index fund, the lifetime cost at 7% is about $264,000. The reframe. Speculation is entertainment. Index funds are investments. If your path to wealth depends on the outcome of a football game or a Twitter post, you don't have a financial plan. You have a lottery ticket. Mistake 12. Co-signing loans. Studies show that about 38% of co-signers end up paying all or part of the loan. 28% see a drop in their credit score because the primary borrower misses payments. And once your credit is damaged, your own mortgage rate goes up by an amount that can cost tens of thousands of dollars over the life of a home loan. The reframe. Co-signing is not a character reference. It is a legally binding assumption of someone else's debt. If the bank, which assesses risk for a living, won't lend to them, you probably shouldn't either. D tier. The ones the internet screams about. The latte factor. $5 a day on coffee, over 40 years at 7%, costs about $400,000. That sounds big until you line it up against anything in S tier or A tier. It is dwarfed by the car trap, the lifestyle escalator, the missed 401k match, and the rent versus buy error. The reframe. Optimize your coffee budget after you fix the S tier and A tier leaks. Not before. The latte factor is a distraction from the structural threats. Now the repair playbook. Because most people watching this video have already made some of these mistakes. Here is the sequence that actually works. 1. Stop the bleeding. Halt speculative trading. Stop adding to credit card balances. 2. Build a 3-month emergency fund in a high-yield savings account. This is the firewall against everything else. 3. Capture the 401k match. Exactly the contribution percentage needed to max out the employer's match. Not more, not less, until the other fires are out. 4. Attack credit card debt. Highest interest rate first. 5. If you're trapped in a high-cost car loan, look at downsizing the vehicle or refinancing. Redirect the monthly savings to investing. The recovery math is surmountable. If you delay investing to age 30 instead of 22, and you want to hit $1 million by 65 at 7% returns, your required monthly contribution goes from about $320 a month up to about $580. Roughly double. Difficult, but not impossible. Which is the whole point. So here's the zoom out. The financial story of your 20s is not about what you earn. It is about what you decide. Most of the mistakes on this list cost you more than a bad career. A 6-figure income with a $1,000 car payment, a rotating credit card balance, no 401k match, and a mortgage you can't really afford is a trap that dresses up as success. The quiet truth nobody puts in the Instagram carousel is this. Wealth in your 20s is mostly a byproduct of avoiding catastrophe, not chasing upside. The S tier and A tier mistakes are what keep people poor. The D tier ones are what keep people busy feeling bad about themselves. Compounding doesn't reward intelligence. It rewards patience. The lifestyle you normalize is the freedom you forfeit. Your 20s don't build wealth. They decide whether wealth is possible. So the only question that matters right now, while there's still time to do something about it, is this. Which tier are you currently living in? And which mistake are you going to fix first?